Most dividend investors default to SCHD because it's popular and feels safe. But sticking with the crowd can sometimes mean leaving money on the table. Is the most popular choice always the smartest one, or is there a better option hiding in plain sight? There's no doubt SCHD is a titan in the dividend world, loved for its low cost and focus on high-quality companies. But in the last 5 years, a different fund, FDVV, has delivered significantly higher returns with a unique strategy. In this video, we'll do a head-to-head, data-driven comparison of everything that matters: performance, risk, sector bets, and exactly what you own. By the end, you'll see a side-by-side simulation of how a $100,000 investment grew in both. And I'll give a clear verdict on which fund is right for which type of investor. You can't pick the right ETF without knowing their playbook. These two funds might both focus on dividends, but their philosophies for choosing stocks are fundamentally different. Think of SCHD as the experienced veteran. Its strategy, which tracks the Dow Jones U.S. Dividend 100 Index, is built on a foundation of proven history and financial strength. To even be considered for inclusion, a company must have paid dividends for at least 10 consecutive years. But that's just the first hurdle. After that, it runs a strict financial background check, screening for 4 key metrics: high return on equity, strong cash flow to total debt, high dividend yield, and a high 5-year dividend growth rate. This multi-layered process is designed to filter for only the most durable, high-quality companies that aren't just paying dividends now, but have the financial muscle to sustain and grow them in the future. It also explicitly excludes real estate investment trusts, or REITs, focusing purely on corporations. This methodical, history-based approach is designed to build a portfolio of reliable blue-chip companies. In contrast, FDVV acts like a forward-looking talent scout. It follows the proprietary Fidelity High Dividend Index, which has a different goal. It's less concerned with a 10-year history and more interested in a company's future potential. FDVV's model seeks out companies that pay a high dividend yield today and, based on Fidelity's analysis, are expected to continue to pay and grow those dividends. This allows it to capture newer dividend-paying companies, especially in sectors like technology, that might not meet SCHD's strict 10-year requirement. It also embraces REITs and even some international stocks, giving it a broader and more flexible mandate. The key takeaway is this: SCHD's strategy is backward-looking, buying based on a proven, decade-long history of quality and stability. FDVV's strategy is forward-looking, buying based on a combination of current yield and expected future performance, which can introduce both higher growth potential and higher uncertainty. An ETF strategy determines what you own, and the difference here is staggering. Let's peel back the curtain and look at specific sectors and companies you are buying. The biggest strategic difference is their bet on information technology. FDVV allocates a massive 24.1% to tech. This is a core part of its growth-oriented dividend story. Because of this, its top holdings include Microsoft, MSFT, a tech conglomerate leading in cloud computing and software; NVIDIA, NVDA, the dominant force in graphics chips and artificial intelligence; Apple, AAPL, a global leader in consumer electronics and services; Broadcom, AVGO, a semiconductor giant crucial for modern communications. In stark contrast, SCHD only puts 8.9% into tech. Instead, SCHD makes its big bets on more traditional defensive sectors like consumer staples at 19.4% and energy at 18.9%. Its top holdings reflect this defensive, value-driven posture: Verizon, a telecommunications staple providing essential services; Chevron, an energy supermajor benefiting from global energy demand; Coca-Cola, a classic defensive stock with unshakable brand power; Amgen, a leading biotechnology firm. Another key difference is real estate. FDVV has a 9.4% allocation to property through REITs, an income source that SCHD completely excludes by rule. This also affects portfolio concentration. SCHD is more top-heavy, with its top 10 holdings making up 41.24% of the fund. This means you have a more concentrated bet on its top names. FDVV spreads its bets a bit wider, with its top 10 accounting for a smaller 31.26%. Now that you see how differently they're built, one banking on tech's future, the other on established value, which one actually performed better? And stick around, because at the end, I'll show you exactly how a $100,000 investment would have grown in both funds, side by side. This is the metric everyone watches. Who made more money? The last 5 years were a perfect stress test for these two opposing strategies, featuring a pandemic crash, a massive recovery fueled by tech, high inflation, and rising interest rates. Over the last 5 years, FDVV was the decisive winner on paper. It delivered a powerful compound annual growth rate of 15.75%. In the same period, SCHD delivered a respectable but lower compound annual growth rate of 11.25%. This significant outperformance from FDVV was largely fueled by its heavy allocation to the technology sector, as tech stocks soared in 2020 and 2021 and also made a spectacular bull run in 2023 and 2024, FDVV's portfolio value was supercharged, leaving the more value-tilted SCHD behind. This period perfectly rewarded FDVV's forward-looking strategy. But here's the crucial context that long-term investors must understand. Performance is path-dependent. When we zoom out and look at the since inception growth, the story gets more interesting. The numbers are nearly identical. FDVV has returned 12.42% per year since it started in September 2016, while SCHD has returned 12.33% per year since it began way back in October 2011. What does this tell us? It shows that while FDVV won the recent 5-year sprint, their long-term average pace is almost exactly the same. The critical difference is that SCHD has maintained that pace over a much longer and more varied market cycle. This long-term consistency is a major factor for investors who prioritize predictability over short-term performance chasing. High returns are great, but preserving your capital is what keeps you in the game. The price of higher growth is often higher risk. Let's look at the hard data to see which fund protected investors better when the market panicked. A key job of a dividend fund is to be defensive. The data from major downturns reveals a clear difference in resilience. During the severe 2020 pandemic crash, when fear was at its peak, FDVV experienced a maximum drawdown of minus 38.35%. This sharp drop reflects the higher volatility of its tech and growth-oriented holdings. In a panic, these are often the first stocks investors sell. In the same period, SCHD, while also hit hard, fell significantly less, with a smaller drawdown of minus 33.37%. Its portfolio of established, financially vetted companies with strong balance sheets provided a much-needed cushion. We saw a similar story play out during the 2022 market downturn, which was a different kind of crisis driven by inflation and rapidly rising interest rates. In that environment, FDVV saw a drawdown of minus 20.18%. Once again, SCHD demonstrated greater resilience, with a smaller drawdown of minus 18.89%. Its holdings in sectors like consumer staples and healthcare tend to be less sensitive to economic cycles, which helped it hold its ground better. The evidence from these two very different crises is clear. While FDVV has delivered higher growth recently, it comes with higher volatility and deeper drawdowns. SCHD has proven to be the more defensive fund, offering better capital preservation during major market declines. For many investors, especially those nearing or in retirement, this downside protection is just as important, if not more important, than capturing maximum upside. We've seen the percentages. Now let's make it real with dollars and cents. Over the last 5 years, which strategy would have made you more money? We'll simulate two scenarios. First, a $100,000 lump sum investment. Second, a more common approach for the average person, starting with $10,000 and investing $500 every single week. Scenario 1, the $100,000 lump sum. If you invested $100,000 5 years ago and let it grow with dividends reinvested, here are the results based on their 5-year compound annual growth rates. Your $100,000 in FDVV would have grown to approximately $207,781. The same $100,000 in SCHD would have grown to $170,412. That's a difference of $37,369 more in the FDVV portfolio. Scenario 2, the DCA strategy, $10,000 plus $500 per week. This is a more realistic test. Over 5 years, you would invest a total of $140,000, $10,000 initial plus $130,000 in weekly contributions. This shows how your actual account might have grown. With this strategy, your FDVV portfolio would have grown to a final value of $212,102 for a total gain of over $72,000. In SCHD, the same investment plan would have resulted in a final value of $188,586 for a total gain of about $48,500. This resulted in a final portfolio worth $23,516 more with FDVV. The 5-year data is direct. In both a lump sum and a weekly investment strategy, FDVV's approach, with its heavy lean into technology, generated higher absolute returns during this specific market period. This simulation is a powerful illustration of how an ETF's core strategy can lead to vastly different outcomes over a multi-year period. So, after all the data, should you ditch SCHD for FDVV? The answer isn't a simple yes or no. The data clearly shows that these are two different tools for two different jobs. The right choice depends entirely on your personal investment philosophy, your time horizon, and your tolerance for risk. Here is the final verdict, broken down by investor profile. You should consider FDVV if you are an investor with a longer time horizon, perhaps in your 30s or 40s, and you have a higher tolerance for risk. You're seeking a blend of high dividend income with more aggressive growth potential, and believe that dividend-paying tech stocks will continue to lead the market. If you want a one-stop shop that includes REITs for real estate income, FDVV provides that. You should stick with SCHD if you are a more traditional dividend investor, perhaps closer to retirement or simply more risk-averse. Your primary goal is steady, long-term compounding and capital preservation. You prioritize a rock-solid, decade-plus track record, the lowest possible costs, and a portfolio of high-quality, financially sound companies that have proven their resilience over time. There is no single best fund, only the fund that is best for you. So what's your verdict? Team FDVV or Team SCHD? Drop a comment below. If you want more data-driven ETF comparisons like this one, hit that subscribe button. And for another deep dive, click the video right here on the screen now.